If you're taking money out of those investments month after month after month, and we all know how earlier this year the market crashed for about 3 months in a row,
Mhm.
that is just detrimental to your retirement savings, especially if you're in your early 60s and you have a good 25, 30 years left to go in retirement. Taking those funds out early with the market turning down, the sequence of that return is going to be really tough to make up. So intertwining that
Yes.
home equity could be key to making both funds last much longer.
What if the best chapter of your life hasn't even begun yet? What lies within you is the power to live brighter, bolder, and truer than ever before. So welcome to Vivatude, where caregiving, connections, and career come into balance, and where your vitality, vision, and voice shines through. Because the revolution isn't out there, it's already within you. Welcome to Vivatude.
Hello, hello. This is Kate Phillips with Vivatude. We are the show that we are supporting those sandwich generation, middle-aged and wiser women, especially those who are supporting seniors in their life, maybe a friend, a neighbor, a parent, a loved one. And I have an amazing guest here today. I'm very excited to have her, Rebecca Porter. I'll introduce her a little more in just a moment, but our topic today is on reverse mortgages. I almost don't want to say that because as soon as I say those words, you probably think you know about reverse mortgages. You might have an opinion. You might have a strong opinion one way or the other. So one of the things we want to do today is roll back some of the myths. We want to look at what it really is, what it does, what are some of the myths and the misconceptions about it. And I'm actually going to start with a reverse mortgage success story in my life. Now, I don't do reverse mortgages, but I used to be in real estate once upon a time. I did do some mortgages, not reverse mortgages, but I learned about reverse mortgages when I was a realtor. And one day, my friend Margot's no longer with this world. This was decades ago, but Margot came to see me. She had lost her husband recently and rather unexpectedly. She was in her mid to late 60s, owned a home that her husband had done some remodeling on, and Margot could not keep up with her bills. She had credit card statements, and she wasn't able to make her payments. And we had lunch, and Margot said, "I'm either going to have to declare bankruptcy or sell my home." And I had just learned about reverse mortgages, and I said, "Please go check this out. See if this can help you." And 60 days later, Margot had no more mortgage payment. Not only did she have no more mortgage payment, but she had a little stream of income, that she had little checks that came to her every month. And she went on to live a long and amazing life. She returned to college. She finished her degree. She was able to do what she wanted to with her time, which was largely looking after her grandkids, and helping her daughter out, who was still working, so that the grandkids didn't have to go into into daycare. And that's just one example of the many ways that a reverse mortgage can help. And with that, I'd like to welcome Rebecca Porter.
Thank you. I am very excited to be a guest today with Vivatude. And anytime I can help spread the positive information about reverse, how it can help people age in place in their home, it's a good day. So thank you very much.
Yes, aging in place. That is a huge, huge topic. And we'll talk a little more about that. Let me give you just kind of a definition of a reverse mortgage in case that, you might not be sure how it works. We all know how a regular mortgage works, is that you get a loan against the property. You pay off that loan monthly, and after 15, 20, 30 years, then you own the home free and clear. With a reverse mortgage, it's a home loan that allows seniors to access their home equity in the form of cash payments, could be a lump sum, could be a line of credit, and I know we're going to be talking about that, without having to sell their home or be required to make monthly payments. Now, you can make payments, but you don't have to. The loan must be repaid with interest once the borrower sells the home, or it could be that their heirs are selling the home, uh, sell the home, move out of the home for more than 6 months. So even if a senior has to go into rehab or something like that, it's not that they immediately lose their home. And so say more, Rebecca, about why you love a reverse mortgage and some of the ways that it can be used.
Yeah, some of the ways, so many different ways, right? So a lot of people, primarily the vast majority, are still using it kind of at that dire need, kind of like your friend, right? So, I mean, nothing makes all of us reverse specialists very excited to be able to really help somebody who is in dire need. But then there's another chunk that's really up and coming that might have saved a good chunk of assets. And one way that they're using it is to help offset their taxes. So maybe they're withdrawing a lot of money out of their investments and they're in a really high tax
Mhm.
bracket, right? Because maybe they have a home payment, but it's not enough to be able to have the interest write off, right? They're not able to itemize. So they're put in that high tax bracket. Well, with the reverse, if they do have a little bit of a house payment, every situation is different. We might pay that off. And then if they have that line of credit where they can pull some income out, that money is tax free. So we can get
Yes.
very creative and help them with, along with their CPA, financial planner, looking at their portfolio. How can we make that portfolio last longer and offset those taxes by taking funds out of the home? Maybe they're not going to take them every month. There's a whole nother advanced segment we could do on sequence of returns with those investments. Because if you're taking money out of those investments month after month after month, and we all know how earlier this year the market crashed for about 3 months in a row,
Mhm.
that is just detrimental to your retirement savings, especially if you're in your early 60s and you have a good 25, 30 years left to go in retirement. Taking those funds out early with the market turning down, the sequence of that return is going to be really tough to make up, right? To get that return back up where it should have been because you're withdrawing and having less to recoup. So intertwining that
Yes.
home equity could be key to making both funds last much longer.
I know exactly what you mean when you say sequence of returns. I've seen the math, I've seen like the software where when that market dips down and or when it sometimes corrects and crashes, that is the worst time to be pulling money out of your stocks. You want to be able, if you can, to let them ride, and the difference is just huge in terms of your long-term returns.
And I know some people or financial planners will say, oh, my clients, I don't have them in the market. But there are people that are in the market. My dad, I mean, he's nearing 81. He has a lot of money still in the market. He's a little bit more of a risky player. But still, there could be another funds, right? So we've got to look at the whole picture. Look at and sometimes again working with their financial planner with their loved ones. But I wanted to clarify real quick. I think you were saying that they had 6 months to be in rehab. They actually could have up to 12 months. I'm just shy of 12 months, right? By a day that you need to be back in your house before that loan is called due. So just
Yes,
wanted to
12
clarify.
months. Sorry if I said
That's okay.
6 months. And what you're talking about, Robert Kiyosaki asked this really important question. He asked about what's the difference between an asset and a liability. And people will quote, especially people who are still renting, they love to quote Robert Kiyosaki, who says, a home is not an asset, it is a liability because it takes money out of your pocket. But I think that is way too limited of a view on what a home is. It starts out We could say it starts out as a liability, and
Mhm.
certainly by that definition, usually when people are renting, it costs them more money to get into a home that they are owning as opposed to renting. But over time, I argue that for many people, the home will be your most valuable and most important asset. And so, what Rebecca's talking about here is using it strategically as an asset. I think a reverse mortgage is one of the best and smartest ways, even if you don't need it. And I'm going to have you address that because now that we've kind of busted the myth that it's just for people who are desperate, you can set yourself up where if you need it, you have it, but you don't have to use that equity. Isn't that correct?
That is correct. And, each state has some different regulations. So here in the state of Washington, the HECM, known as the Home Equity Conversion Mortgage, which is the FHA insured product, comes with a line of credit. Really, I think it's easiest just to think of the whole entire loan as one big line of credit, because that is essentially what it is. They also have fixed loans, but this line of credit is a variable, like most lines of credit, which some people can go, they get scared about. But when they understand and I talk them through the ins and outs of it, that there's caps, lifetime caps, and that it comes with all the bells and whistles with all the features. And that feature is that line of credit. So the best thing about that line of credit, and this is pay attention, people, because this is what is hard for some people to wrap their head around. Whatever you're not accessing in that line of credit. So for example, you have a $200,000 line of credit. You only used 50,000 at closing. You have 150,000 left on it and you don't need it. Maybe you're even still working, right? Or maybe you're just in your early years and you've got good pension coming in or some, good other retirement funds and you just don't need it. Believe it or not, that line of credit has an attached compounding factor to it. So that 150,000 can grow and grow and grow. So it's equity, right? People think it's cash. Well, it's not. It's available cash. It's not cash invested. It's a compounding factor that they're going to add a little bit more equity that you can draw from every month. So that's great news if you don't need it when you're younger, but maybe you're planning to age in place. And by the time you're in your late 70s, 80s, you're going to have literally close to $1 million that you can access later, whether the house increases in value or not.
We've got to go to a break, and I'd love to hear more when you come back about the line of credit and how people can actually access more of their equity by setting this up in advance. And when they're not feeling desperate, when they're not absolutely needing that equity, they can be prepared to use it. We'll be right back with Rebecca Porter, and I'm Kate Phillips here for Vivatude.
And thanks for listening to Vivatude. 4 hosts, 1 each week. We help you revivitude your next chapter because purpose, passion, and prosperity isn't out there. They're already within you. Brighter, bolder, truer. Vivatude.